What are trading expected returns? Expected returns refer to the potential profit or loss an investor anticipates from a trading activity. This metric helps traders evaluate the risks and rewards associated with investments. It is a crucial concept for building strategies that align with financial goals. Expected returns are usually expressed as a percentage and derived through mathematical models. These models incorporate factors like historical performance, market trends, and economic conditions. Expected returns are not guarantees but projections that rely on mathematical models. By understanding expected returns, traders can compare potential investments, assess the risk-reward trade-off, make informed portfolio allocation decisions. Expected returns heavily rely on probability. Traders use statistical tools to assess the likelihood of specific outcomes. They combine these probabilities with potential returns to estimate the overall expectation. Just a quick reminder to please hit the like button and subscribe to the channel to continue receiving great content like this. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 25% off your next purchase. For instance, if an asset has a 50% chance of yielding a 10% gain and a 30% chance of incurring a 20% loss, the expected return can be calculated. This method provides traders with a clearer picture of potential outcomes, aiding in better decision-making. The calculation of expected returns involves statistical formulas that incorporate potential outcomes and their respective probabilities. The most commonly used formula is expected return equals the summation of P and X multiplied by R of X, where P of X is the probability of a specific outcome, and R of X is the return associated with that outcome. For example, consider an investment with the following outcomes: a 50% chance of gaining 10%, a 30% chance of gaining 5%, a 20% chance of losing 5%. The expected returns would be calculated by multiplying 0.5 times 10 plus 0.3 times 5 plus 0.2 times negative 5 equals 5 plus 1.5 subtracted by 1, resulting in a 5.5% return for the investment. This example provides a benchmark for evaluating the investment's performance against other opportunities. In portfolio management, expected returns are indispensable for diversification and risk management. By analyzing expected returns across a range of assets, traders can construct portfolios that balance risk and reward effectively. An important metric derived from expected returns is the risk-adjusted return, such as the Sharpe ratio. It measures the return per unit of risk, helping traders evaluate whether an investment justifies its inherent risks. Factors influencing expected returns. Asset-specific characteristics. The inherent properties of an asset, such as its historical performance, market demand, and liquidity, play a crucial role in determining expected returns. For instance, high-growth tech stocks typically exhibit higher potential returns compared to stable utility stocks. Market conditions. Macroeconomic factors such as interest rates, inflation, and geopolitical events can significantly impact expected returns. For instance, rising interest rates may lower the expected returns on bonds. Risk tolerance. Investors with higher risk tolerance may focus on assets with potentially higher returns but greater volatility, while risk-averse investors might prioritize stable but lower return investments. Time horizon. The length of the investment period influences expected returns. Long-term investments often provide higher returns due to the compounding effect, but they may also involve more significant risks. Despite their importance, expected returns have inherent limitations. Dependence on historical data. Predictions based on past performance may not hold in future market conditions. Subjectivity in probabilities. Assigning probabilities often involves assumptions, which can lead to inaccuracies. Impact of unforeseen events. Unexpected developments, such as economic crises, can render expected return estimates invalid. Conclusion. Trading expected returns are fundamental in assessing the potential profitability of trades and investments. By understanding how to calculate and utilize them effectively, traders can make more informed decisions, optimize portfolio performance, and navigate the complexities of financial markets with greater confidence. Incorporating risk management alongside expected returns ensures a balanced approach, enhancing long-term success. Thank you for watching.